Stock indices have been pushed up recently with some benchmarks scoring all-time record highs. James Stanley joins us now from DailyFX with some analysis. James, how long can this rally be sustained?
Certainly. I think that this is at least a little bit long in the tooth. I think, if we go back to the night of the election, the initial run in stock prices was aggressively lower. And it was around midnight, just before Donald Trump's acceptance speech, that we started to see a reversal. And then there was a weird vacuum period there about a week after the election where there was still a lot of disbelief in the move, but it was a concerted bullish type of thing. And if we draw back to that, we really had a combination of two things that were helping to propel stock prices. We had a Federal Reserve that was thought to be ready, willing, and able to come back to markets in the event that anything cataclysmic might have happened. So we had that kind of that downside support. Very similar to what the Fed did in February. Coming into 2016, they expected to hike rates 4 times. We saw some tumult in the first 6 weeks of the year, so the Fed backtracked. And they went really dovish, or they gave dovish commentary. Lo and behold, we didn't get a rate hike until December. Right after the election, I think that modal was still very much operable, where if we did see pressure in stock prices, we were under the expectation that the Fed would come back to the table with something more. At the very least, no rate hikes. Of course, we saw that Trump trade really take on a life of its own. Stock prices drove up to new all-time highs. Valuations got really expensive again. And now the Fed is more hawkish. They hiked rates in December. They're looking at 3 hikes in 2017. So that scenario that led to the Trump trade is already beginning to shift. The question is, when is price action going to catch up to that? I'm of the belief that we've already begun to see that shift happen. I think upside on stocks could be challenging from here, even given that more robust backdrop that we have with the hopes for fiscal stimulus coming online at some point in, within the next couple of years.
So what happens then when the Trump euphoria ends?
It's a good question. I don't think that we're looking at a binary markets are up, then markets are going to crash type of scenario. I think the Fed is still the big factor there as to how aggressively they're looking to normalize policy this year. As in, if we do see some pressure in stock prices, what's going to get them to abate from this more hawkish stance that they've taken on post-election? My expectation is that at some point we're going to see a range-bound S&P at a lower level than we're at right now. The question is, how much lower is that going to be? The comp that I'm looking at is the summer of 2015, when we had range-bound equity prices up until we had that factor of Chinese worries that hit in August.
With that in mind, what should traders be looking at?
I think what's really important here is diversification. As traders, we have a tendency to get very myopic, especially when we get these very pronounced themes as we had around the Trump trade, where it could be real easy to just kind of ignore everything else and focus on the hot dot. I think right now what's really important is looking at the full playing field, not putting the entirety of our efforts in just chasing or trying to fade that Trump trade, because frankly, there's a lot of volatility and there's a lot of risk there. Some of the areas that I think might be a little more attractive are areas that haven't been in the spotlight in 2016. For me, that's the euro. The ECB basically threw the kitchen sink at this thing in December. The Fed followed up a week later with some really hawkish additions to their 2017-2018 forecasts. The net euro-dollar barely budged down to a new low and then moved back up. So I think that that's something that's going to take on more of the spotlight coming into 2017. Also, given that we have European elections later on in the year from both France and Germany, I think that's something that's going to remain fairly volatile through a good portion of this year.
Okay, James, look, thanks for joining us. James Stanley is there from DailyFX, joining us from his offices in New York.